check, 1, 2.
Go! Curious about real estate? Yes! Then you've come to the right place. Get the knowledge you need, get over the fear, and get started. This is the Michael Quarles Real Estate Show with your host, Michael Quarles.
Hello everybody, Michael Quarles with the Michael Quarles Real Estate Show. Today we have 5 questions sent in by real estate investors, and remember, if you have a question, send it to support@michaelquarles.com. Here we go, let's get started. Question number 1. When doing the market analysis, are there any guidelines or benchmarks to know if the market being analyzed is good or bad? For example, is 128 average days on market good, bad, or indifferent? Are many pre-foreclosures and REOs good, bad, or indifferent, and so on and so forth? How much is too much? Are there preferred targets? There are. The marketing analysis is something that our coaching students all go through so they can run an algorithm on their local market. They look at what parts or portions of their market they should be concentrating on. Most markets are pretty good size. Most people don't have enough marketing budget to canvas the entire platform or the entire geographical. And so we have to pick the ones that we shouldn't be marketing to. Even if we had enough budget to send everybody something, we shouldn't send everybody something because some of the areas are going to tell us, in fact, that we should not be sending them something. As an example, let's say, for instance, your median in your market's 225. I know that you have neighborhoods that are in the $1 million price range. I absolutely know that. Well, we want to stay away from those areas unless that's our market. Unless that's what we do, we want to stay away from those. The same thing is true in that same market at 225 or 220. I know there's markets that'll sell for 40 or 50. Probably want to stay away from those too. We want to be at their core competency, and we know that median is it. What median represents is the number of the price tag of the property that's right in the middle of all the properties that sold. The ones below it and the ones above it, but it's right there in the middle. It's not an average. I like median better than average. But when we look at a market, let's assume for a second we're looking at 10 zip codes. We want to determine which one of those zip codes I should be marketing to, or which 2 or 3 of those I should be marketing to. Well, one of the considerations that we have to take into consideration is how many investors are buying houses in that market or in that zip code with cash. Let's face it, we're going to sell our houses for cash. We want to know where the cash buyers want to buy. And this gives us 2 things. It gives us where the cash buyers want to buy, but it's also giving us where the seller has been predisposed to selling to us, like-minded people, and which I like too. So I want a high concentration of cash buyers. I also want at least 1,000 single-family units inside of a zip code. I don't want less than that. It's too small of a zip code. But if it's a huge zip code, like there's 20,000 units, well, that may be too large. And the reason I'm looking at how many units in a zip code is I want to know how much or how many of those houses, if I buy one, I can use from a marketing perspective to influence some of the other ones that'll be for sale. Let's face it, if I bought a house on a street, I know on that street 2 houses are going to go up for sale within the next 6 months. I just know that. Well, if I did my job right, and I told everybody that I was buying a house and flipping it and I'm available, my money's here for you, then those 2 people will know about me. And the larger and larger and larger territory that you have, the harder it is for everybody to know you. So the smaller the better. However, it can be too small. So under 1,000 I don't like. I like REOs, houses that have been foreclosed upon that the bank owns. I like pre-foreclosures. I love the propaganda that allows me to have with the seller. Let's face it, if a seller is trying to sell their $100,000 house for $70,000, and I can buy the same house from a bank for $50,000, I'm just going to ask the seller, if you were me, would you buy your house for $70,000 or would you buy the same house down the street for $50,000? And I know they would say down the street for $50,000 because everybody's practical. If they don't say that, they're lying to themselves and they're lying to me. So I like the fact that there's some REOs. Now, if a street has a lot of REOs that are boarded up, I'm not going to buy on that street. But that doesn't mean I don't like the REOs. I'm just not going to buy on the street because I don't want those lenders to dump the property values and kill me on my value if I own a property. So there's things that we want to consider. Days on market, we want to consider that too. We want to consider the inventory of the median value. We want to see the equity-based positions. We want to see how many people have a house that's in the top third, middle third, and the bottom third of median with an equity position. We want to look at all those, and there's some more. There's other numbers that we look into. We want to have the best chance of being successful. So we do a little bit of homework, and it takes us 6 to 8 hours to do this algorithm, but it's well worth it. So great question. Question number 2. Can you ask Michael what he was just for the following? I have a property under contract that has nuisance liens and unpaid taxes totaling $6,500. It requires a quiet title action, which would cost about $500 to $1,500 and take 2 months. The seller just wants to quick claim it to me, and the BPO report says that a 30-day as-is sales price is $14,500. So we're in the little mini market, and it has some nuisance liens that the quiet title could get rid of. But go ahead and take the quick claim deed. Take the quick claim deed and then do the quiet title. No big deal. Piece of cake. Just know you're going to have to wait 2 months to do the quiet title. And piece of cake, yeah, get that thing. Now, it's a little skinny, itty-bitty deal, but if that's all you got in your area, maybe you're just in a little skinny area. And that's fine. That's fine. You just have to do more of them. That's all right. Good job.
Thanks for listening. We'll be right back. Are you running out of leads? It's time you tried Yellow Letters at yellowletters.com. Get motivated seller leads through yellow letters, postcards, zip letters, typed professional letters, greeting cards, door hangers, and business cards. Yellow Letters is a full-service marketing company created with your success in mind. Get the personal attention you need to get your direct mail campaign started and get in touch at yellowletters.com.
And we are back in 3, 2, 1.
Question number 3. Can you explain passive versus dealer status? Is this only a tax thing? Does it mean something different? Sure, it does. It is a tax thing. It's a big tax thing. So you can't have dealer status and passive status at the same time. So you can't have one piece of property you have passive income and another piece of property that you have dealer status. You're going to have dealer status on both. So which is why we can do passive status in our personal name, and we do our dealer status in a sub S corp. Or a lot of times your accountant will say do your passive in an LLC and your dealer status is in an S corp. So subchapter S corp. Corps come out as C corps, and you convert them within 45 days of establishing it or 90 days of establishing it to an S corp. The difference between the two is one's a calendar year taxation and the other one's at every 12 months after filing. And the calendar year taxation passes on to you as income rather than the dividend tax and the income tax on the C corp. So I like dealer status. I don't mind it. You know, it's expensive, sure. So dealer status is, let's define that like a regular business. Let's assume for a second you sold books. You bought a bunch of books and you added $10 to the price of every one of those books and you sold those books. Well, you're a books dealer. You're a book dealer. You're making money on selling the book. Well, in the house flipping business, that's what we're doing, is we're buying houses, we're adding something to the house and we're selling it. We're not holding on to it for a long time. It's not our intention to rent it out. And so because we're flipping it, selling it, then we have dealer status. Now, can you have passive status on a dealer transaction? That would be a question for your accountant. But the IRS, the question is what was your intent? So I think you can prove intent once or maybe twice, but you can't prove intent every time. And the reason passive status is always nice is because it's a cheaper tax rate. You don't always get it. So check with your accountant. Great question. Question number 4. And our last question today. There's only 4 questions. The seller needs money to buy a trailer house, but they won't have anywhere to go until I close on this house. My question is could I best use sub 2 in this scenario so I can avoid the extra costs of transactional funding? I think sub 2 would be the way to go, and the contract would state, I guess they got that one wrong, when I close my side that the proceeds pay off the mortgage. Ouch, don't do that. So let's say we close in 30 to 45 days. Would you do a weekly lease or a month to month? I would think that this might hurt my ability to sell it, and I'm worried if he wouldn't move out and we might have an eviction on our hands. Yeah, I don't like to keep the sellers inside the house. Please don't do that. So when you hand the seller your cash, 5 days prior to that, they would have had to handed you a vacant property. As an example, like I'm closing one this week and it was supposed to close today, but they didn't go and get out until yesterday. People, it's 5 days. Okay? Just because you thought you could get out Saturday and close today, no. You get 5 days. I get 5 days to inspect it. I'm not going to be hurry up, Mike. I'm going to be do it within my system's time frame. So 5 days prior to close, that has to be vacant. You're going to go out there, confirm, or somebody is if you do this virtually. Don't do a lease back. Please don't do it. Don't do any of that stuff. Now, sometimes you just have to. I get it. I understand. Everything I just said is crap if you have to. But most of the time you don't have to. Rarely do you. I mean, I've done a lot of real estate transactions. I'm hard pressed. I mean, I have a form for this that the coaching students use if they have to do rent back on the seller. And here's the thing, you got to make it expensive. So if you do a rent back, it's not just regular rent. It's like 3 times the rent value, and then you hold a chunk of money in escrow so they can pay you that rent back, and that chunk of money also is there in case you have to do an eviction. So it's expensive for the seller to do a rent back, and you rarely will ever do one. Now, here's something that, when your question that I'm concerned for you, and I'm going to read the statement again. I'll try to do it with all the right words. I think sub 2 would be a better way to go, and the contract would state when I close my side that the proceeds pay off the mortgage. Do not create a deed restriction, please. Don't tie your performance into the ownership of the property. Because let's face it, what happens if you can't do that? You don't know. You can't. No one has the crystal ball. As good as we think we do, most people's crystal ball is black like a bowling ball. So you can't predict the future. So don't restrict yourself in the future by something you're unaware of. So I would not say that I'm going to pay you. Now, that would be my intention. Absolutely. But I'm not going to put it in writing. Just not going to do it. And if they don't want to sell it to me that way, that's fine too. I mean, let's face it. I can give them a itty bitty more money to do a sub 2 purchase than I can on a cash. But if they don't want to do sub 2, I'll just put cash out. I'll get that transactional funding and be on my way. It's okay. They're going to cover my costs of money. So if they want to do sub 2, they can get a little bit more because I don't have a lot of cost of money there. But if they want to do cash, they're going to cover the cost of my money and they're going to get less. That's okay. I'm fine with it. I'm going to cover, every time we spend money, we should, whatever we spend, multiply times 2, and that's how much we should make. A lot of us, though, unfortunately, we only charge what it costs us. No, double it. Always double it. Double. If you guys watch the Shark Tank, man, they're multiplying it like by 5 and 6 and 7 times. So they make a little widget, and it only costs them, $7. They're selling that widget for, $50. Well, we need to work in that same kind of logic, but a lot of us just charge the 7. No. So don't restrict yourself on the resale that says you're going to pay off the mortgage. Now, I won't keep it in place, but I don't want to restrict myself. I don't want to have a deed restriction that could unwind the ownership of that property. So make sure that you don't do it the wrong way. Get into the coaching program. Let me teach you how to do it. Coaching program is only $297 a month for 6 months, or $1397 for the 6-month period. Oh my goodness, we got 60 classes a month now. Accountability coach for one-on-one training. We have videos and audios and resources and forms and CRM system, which is amazing. If you want us to answer your phone, we have a call center for all that. I mean, that call center is doing great for folks. Great for folks. Man, it is absolutely churning for folks. So if you're thinking about learning real estate investing, give us a shot. Shout out to us. Let us explain to you the program and how it works. And until next time, talk to you then. Bye-bye.
Thanks for listening to the Michael Quarles Real Estate Show. Get more info and stay in touch at michaelquarles.com.